But that goes back to the negative connotation of volatility, which is what I fell right into. But that's the point of like, we think of most people think when you hear volatility and the market's going straight up, the volatility index is usually really low when the market's going straight up because that's the fear index.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with John.
Hello.
And Lee.
Good morning.
And we've got some stuff to talk about. It's been a fun start to the year in the markets. A lot going on, some moves, some dynamics shifting and changing. So plenty to talk about. A few things that we're going to get into, but to start, we want to start by talking about kind of our question of the day. So, question of the day is: how should investors? Sorry, I was looking at the wrong one. How should you react, or what should you do during periods of heightened volatility? So, kind of an open-ended, vague question, but a lot of different ways we could take this. So, Lee, what are your thoughts when you hear, if someone asks you, it's like, hey, the market's been volatile, like, what should I do?
One thing that comes to mind, and this is kind of establishing some foundational points, is volatility. Volatility doesn't always mean negative. I think people associate volatility in a negative way.
We're like dropping off a cliff.
They attribute volatility to the markets are going down.
Struggling with that word.
Sorry, I'm tired. It's normal. Okay, I mean that's one of the very first things that we talk about with clients is volatility is normal. Now, it's more pronounced in certain times, and we're going to talk about that a little bit later. But we're not market timers. Day traders love volatility.
Sure.
I mean, they're playing the ups and the downs. But if you're a long-term investor, which our clients are, and we're long-term managers, you stay the course. I mean, you dollar cost average. That's why you're putting in your 401k plan.
Yeah,
every month.
Volatility can lead to a lot of opportunities.
Absolutely. I mean, it's volatility, in my opinion, just presents great opportunities to educate. Mm-hmm. And again, I just go back to the point of typically when a client comes in asking about volatility, it's not it's in a negative way. I mean, they think things are bad. John, what are your thoughts?
Well, I just think that that's a great point, and I also add every situation is a little bit different. Sure. Volatility hits people a little bit different. So I'll give you an example. Last April 1st, the Trump tariffs came online, right? And it created massive volatility, if you remember, right? And negative volatility. The market went down about 22% from top to bottom in that short 3-week trading period because of fear of the tariffs destroying the U.S. markets, right? Well, when that fear subsided, the market quickly recovered. In fact, the quickest recovery ever in market history. And this is the point. Had you in that time frame reacted based on emotion, based on fear, based on the market, based on volatility, and you would have gotten out, let's say the market's down, because you never time it perfect, right? Volatility happens, and then you panic and get out. So that means you're already down when you decide that you can't handle it, and then you miss out on the recovery, and that's the danger of like trying to time the market, trying to, and I guess some of the things like ignore the noise, I think, is a big way to advise people. Don't let the heightened, when you're watching TV and the financial channels and everything's just a massive story and it's going to end the markets as we know it and everything's going to be bad. Just ignore the noise, stay the course, don't panic, know what your risk tolerance is, what you're able to handle, rebalance to the target if that's something you need to do. I also say, like, in the middle of a massively high market, we just hit, I'm going to say a word that Matt is called the Dow. These young guys know the S&P more, but the Dow hit 50,000, right? And we've hit it again, and so it dipped back down. Now it's back there, so record highs again. This is a great time if you're worried about volatility, if it does make your stomach upset when, like last April or this year's, already a few days, then this is a great time to rebalance your portfolio and take some profit off the top and rebalance into safer things. So know when, understand the markets and pay attention to them when they get to these high levels. If you're out of balance, rebalance. But for the most part, ignore the noise, stay the course.
If you're overly
time
worried
the
about
market.
volatility, you're probably not invested appropriately.
I would agree.
Exactly.
The perfect portfolio is one that you can stick with, both in good times and bad, right? What's hard is, we talked about this on the show, and I talk about it a lot, is there's two things that drive investors' emotions and decision making. It's fear and greed. So finding a portfolio that you can stick with when everything's going extraordinarily well, and you don't get greedy and start changing things, trying to be more aggressive to take advantage of that. And then the opposite's true. You don't get fearful and do something. And finding that portfolio that you can stick with both in good times and bad is, hopefully you're positioned for the volatility on the front end, so that when things get volatile, that doesn't necessarily mean your portfolio is moving or doing things that get to a level that you're uncomfortable with, right? You kind of expect to know how you're positioned and what you should expect when things get dicey. But yeah, volatility can create a lot of opportunity. Ideally you're positioned well for it on the front end. You don't wait. I think what you said is absolutely true. If you've done well, like if you've been doing better than you need to do, and the market's giving you more than you need, like, I say greedy. People are gonna be like, why do you keep calling me greedy?
Yeah.
But like, don't get greedy. Like, take advantage of that and say, okay, we're going to lock these in. We're going to make sure we're repositioned now. If the market continues to go up, great. But you'd rather rebalance now, lock in those gains, get yourself positioned so that whether it's this year, next year, or 5 years from now, there's a market sell-off or we have a correction or something, you can handle it and you can ride through it. If it happens before you're positioned appropriately, it's too late and you're kind of stuck and you have to just ride through it.
As an old farmer once told me, pigs get fat, hogs get slaughtered. Don't be a hog. Is that what you're saying?
That's well said.
Okay, thanks.
I'm
going
to not disagree with you, but this podcast, we're going to banter a little bit.
The banter's good.
I did not think last April was volatile. I thought maybe a couple years ago when
2022,
when every day it seemed like we had 1% and 2% swings.
Sure.
Up. I mean.
Oh yeah.
To me, that's volatility. Where it is just, you walk in and it
depends on how you're defining volatility, for sure.
Correct.
Because like if you're defining it by, if you're just looking at like the VIX, which is like the fear index.
Correct.
It's right. It's like, well, the VIX definitely spiked, right?
In April.
In April.
It did.
But I know what you're saying in terms of that kind of longer lasting, the up and down moves of just kind of these, you have 2 and 3% up days, 3 and 4% down days, and just these big wild swings. It wasn't really
Which we've experienced more of that in this year.
Correct. So from 1st of May through the end of the year last year, market straight up, theoretically.
Sure.
There's no volatility in that market, in my opinion. Yes,
but that goes back to the negative connotation of volatility, which is what I fell right into. But that's the point of like, we think of most people think when you hear volatility and the market's going straight up, the volatility index is usually really low when the market's going straight up. Because that's the fear index. Mm-hmm. And fear is only when the market's getting sold off. So I look at it like volatility equals fear, even though, that it's kind of the way I've looked at it. But I look at like we're going to have these types of markets on and on and on. And if you are, to Matt's point, which is the best point, know what you can handle, know what your risk tolerance is, know what your expected outcome is, what you need to be taking in risk. And then try to stay that course. And once you're in that, don't panic and don't worry about the volatility, especially the negative side.
Well, to your point, so this is one thing, like with, standard deviation is a measurement of
That's
volatility.
That's where I was going with that, yeah.
And so people think volatility as only negative, but you can have a very high positive standard deviation, and
which would be
highly volatile, but you may not, which would mean it's highly volatile, but doesn't necessarily mean it's highly negative, right? It just means it's moved a lot.
Correct.
So the price has moved a lot. So the volatility is high. The standard deviation is high, but it's not down a lot. So it's kind of, I don't know, tomatoes.
Well, and oftentimes when we're doing these risk measurements, it is more of a measurement of, I think we get hung up on when we're doing these risk scores is basically how much can you let it go down.
Right.
But truly, to Matt's point, it is more of a how much can you stomach these wild swings. I mean, these one standard deviation is so much either up or down. I mean, I've got clients that oftentimes get as nervous about these just crazy swings more than they do.
Well, everybody, we're all human. You have 3 days in a row and the market sold off.
Makes you feel a little squeezy.
4, 5, 6%. I mean, every one of us are sitting there saying, "Here we go."
Yep, exactly.
Here we go.
Sure.
And then it's the market will humble you because you think you can't listen to your gut. Every time you think, oh, it's like my gut's telling me, it's like, here we go, like we're about to see a legitimate pullback, and then the market will just kind of.
I got to pick on my son for a second. I've taught him how to invest. He's 23 years old. When the market was down last week, a couple of days early in the week, Monday and Tuesday, he called me and said, "Dad, this is the beginning of the end. I know it. I feel it. It's the beginning of the end." And I told Connor, he's 23. I said, "Connor, that's about the 40th time you've told me that in the last 5 years, right?" And it's always a headache. It's like, you're 23. It's going to be okay. Stay the course. Don't panic. Don't get out. And this is a 23-year-old that has all the time in the world in his hands and loves the stock market. And that lets that little tinge of scared thing get in your mind, the fear, and then you make a bad decision. And I think that you want to avoid making those types of emotional decisions right in the time. And in the market, going back to 2009, the market on March 7, 2009 the Dow was 6,400. Today it's 50,000. Mm-hmm. In March of 2009, there were a lot of people that were fearing the market and didn't want to invest ever again. And there are people that missed out on a 6,400 to 50,000 growth through Democrats and Republican presidents, right? So like this fear.
And Trump's predicting 100,000 by the end of his term.
I heard that, yeah. So we're fearing, we fear who's in the office, right? They're going to be crazy. Either side, right? Yeah. I'm not saying one side or the other. Either side. You're fearing global problems that do happen, but they end up getting resolved over time, right? All these fears that are thrown at us now, and now it's a kidnapping in Arizona that's made everybody afraid of the markets. No, I don't think that's scaring the markets. It's a sad story. But we're like, all these things that we get thrown at, and it just creates fear, creates selling, creates all this pressure. When in reality, if you just would close your eyes, let the market do its thing, from 2009, 2026, you'd have done really, really well without letting emotion get involved. And people, I'm afraid, make bad decisions during that time. We try to talk our clients into, staying the course, but also knowing what they are supposed to be in the first place so they don't have to worry about this stuff.
So looking at, volatility and during specific times and, looking at this year being a midterm year, we'll throw this chart up. Midterm years are historically more volatile than other years. So if you look at presidential terms, the first year in office, midterm year, pre-election year, and then the election year. The third year, pre-election year, is typically the best year with the lowest intra-year drawdown. In the midterm year, you can see the average return for the stock market for the S&P 500 is the lowest and has the highest average intra-year drawdown, right? So just historically speaking, it wouldn't be weird for this year to be more volatile and to have a little bit of a pullback, and maybe it's not as great of a year in the market. Doesn't mean that's how it's gonna play out, but that's just it wouldn't be that surprising or uncommon.
One thing to help with that too, when we're talking about all these things, is you don't have to have every dollar in the U.S. markets. Right, you can have money outside the U.S. Right. So if you fear volatility in a U.S. midterm, or you just fear things or were overpriced or whatever the topic du jour is, but you still want to be invested, diversify outside the U.S.
Yeah.
Right, and the international markets we saw last year actually performed very well. You got to know the risk, of course. There's risk associated with that, just like anything else. Sometimes very high risk, depending on what you're doing. But you can, to avoid some of these things, diversify across different things, diversify in sectors inside the United States, right? Remember, we're kind of seeing a shift a little bit from growth to value.
Sure.
We're starting to see the value side start to pick up. In fact, it's actually pretty good signs that's happening, right? It's broadening market. All that's healthy, in my opinion. But we're seeing growth get a little bit attacked where value is starting. So diversifying your portfolio, making sure you have, I think a mistake you can make is like everything's hot, so you just want to be in all the hot stuff, whether that be right now gold or tech stocks or tech names, whatever. And I think that's another lesson to learn from this is make sure you're diversified properly. Don't always chase the hot stocks. Don't panic sell. And don't wait on the sideline for the perfect moment because it may never happen.
Yeah. Okay, last chart I wanted to look at today. So this is the January barometer. So it's like, what does the market do in January, and then what does that mean for the rest of the year? So historically, so the January barometer is a market observation that compares how the S&P has historically performed over the remainder of the year, depending on if the month of January is positive or negative. So the month of January for this year, we were up 1.74%. For the month, this is the S&P 500. When you look at the full year gain historically, when the January has been positive, it's averaged 16.95%. A negative January historically has been associated with an average full year loss of negative 1.75. So this just shows you the average path of the S&P 500, based on what happened in January. So means absolutely nothing, but it's fun to look at.
It's fun to look at.
But they give good signs.
Yeah.
But then you throw in, like you just said, it's an election year. It'd be interesting if you
see this just in election years.
Just in election years. In this midterm, typically, historically, the party in office loses
at least one of the
houses.
Yeah.
Yes.
I think it's only happened once that it didn't happen.
That it did not.
Yeah.
And so, but right now, I think from what you're hearing, no one knows.
Right.
I mean, no one really knows. I mean, so, and again, if you still have gridlock, nothing's going to get done.
Yep.
No crazy things will be passed.
It seems like we have gridlock now. One party
because
controlling all three. It's crazy.
Yeah. So
may not change anything after the election.
Yeah. So I think, to what we've been talking about the whole time, I do think this year will continue to be volatile. There's just no real direction. I've shared with clients, there's nothing that on the horizon that tells me that, man, this is going to be a banner year, but there's nothing that out there that tells me that it's going to be a bad year. We're just going to kind of go where the wind blows us. And right now, like you said, the winds are definitely favoring value stocks that have been out of favor for many, many years. We've talked about this for the last week or two. Some of the big growthier tech names, man, they're getting punched in the teeth, this year.
They are.
But that's also like it's off of all-time highs, right? They're not selling off.
Correct.
At a low, like
right.
When they're hitting 52-week lows and selling off, like they're selling off at all-time highs when, So I say that it's okay. It's normal.
And the other thing too that was a point I was going to make, but the other thing too, the money is not necessarily going out of tech or growthier names and going on the sideline.
Right.
It's going into. Take a look at Walmart.
Yeah.
In our backyard.
There are other companies that are trying. Walmart's a great example, in my opinion, that both the company obviously and the market as a whole is trying to. They're trying to create new leaders.
Yes.
Like I think people are. Investors are kind of like, okay, we're still gonna own Nvidia, we're still gonna own Meta, we're still gonna own Amazon, Microsoft, but we're just not gonna be as overweight as we were, or equal weight with the indexes. Maybe we'll be slightly underweight and start trying to find some new leadership, and we'll see. It'll be interesting to see if that comes to fruition, and if it does, which company is best positioned to take advantage of that.
Real quick, CNBC has a contest, and I think it's maybe for the whole year, where they bring in celebrities and they make their stock picks. The winner was announced earlier this week after the Super Bowl. Okay, the man who won it, the two stocks that he picked, Warner Brothers Discovery and Walmart. So it shows how that. Yes,
because I'm sure everybody else had tech names for sure.
Some of them had tech names, but I just thought two bluest of blue chips.
Yep. You know, it's amazing. A year ago, probably, we were sitting here, or maybe, a year ago, talking about how the Mag 7, how long is the Mag 7 going to lead this market? Mm-hmm. And you had data, and we had stats that said that if you took the Mag 7 out, the S&P actually would be negative. And you remember all that?
Oh,
the Mag 7 was just driving everything forward. I think, like I said before, I think this is healthy for the market. I'm very happy to see stock. Now, of course, Walmart, we're here in Northwest Arkansas. Walmart's big to us here. But I'm happy to see other stocks leading the way. And that it's white, because that to me is a sign of a healthy market.
So here's
the overall economy is doing better.
On this note, and then we'll wrap up. So on this note, waiting for this to download. There we go. Man, I'm getting good at this. Look how quick I found that. Pulled it up. Good. So this Exhibit A from these guys who put this out is awesome, where we get a lot of this data. So S&P 500
this will be on the podcast, right?
Yeah, we'll show it on YouTube. So S&P 500 versus S&P 493 versus the Mag 7 in 2026. So you see the Mag 7 is down. This was as of year to date through the 9th. So yesterday.
Yesterday.
So Mag 7 was down 1.9%. S&P 500 was up 1.74, like we said, and the S&P 493, so ex Mag 7, was up 3.91.
Yeah, awesome.
So
interesting.
Yeah, so definitely some broadening out, some sell off in the big names. But what's interesting is how sold off some of those names are. And the market, in the S&P, the index has held up.
Yeah, sure. if you'd have said 6 months ago, the Mag 7 is going to be down 1% in January, which is on pace to be down in the teens for the year, right? I mean, if that kept the same pace. If we'd have been told that, I would have guessed that the S&P would be down, right? I'd guess that the overall markets would be selling off. It's so nice to see
we had a day last week.
Markets picking up.
We had a day last week where, most of them were down 5 to 10%. Yeah. I mean, Microsoft was down 8 or 9, and the NASDAQ was up. The S&P was up.
Right.
I mean,
NASDAQ wasn't up.
Yes. Yeah.
But anyway, so a lot of
interesting stuff.
As an investor and advisor, it's kind of exciting times. We like to see these shifts in the markets where it's not just the same old and how it's been for years. Broadening out's fun, exciting, it creates opportunity. So interesting topic, fun topic. But any parting thoughts or words of wisdom?
Stay the course. If you're invested, know what you're supposed to be invested in. Don't be over, if you panic when things go sideways, you're probably not in the right investment allocation to begin with. So know that, and then stay the course once you realize once you feel comfortable with what you're in, stay the course, understand the risk. Don't let the noise take you off course.
What he said.
Mic drop. All right. Well, as always, we appreciate you guys watching and listening. Give us a like, subscribe, shoot us an email, leave us a comment. We really appreciate you guys, and we'll look forward to seeing you next week.
Have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.